function, how does it make money, or rather what happens to your money when you deposit it in the bank. The idea would be to keep it very, very simple, not try and use too many jargons, to make it very, very practical and lively. And at the same time, if you have any questions, please feel free to put it up as a chat. I'll be happy to take them up as and when I get. We will also maybe devote some 10-15 minutes at the end of the session to particularly take some questions and so on. Yes, I do have a comment from somebody who's from the tech field. Well, sure, I would want to make it very, very simple so that the session is not really towards people who are from finance or commerce background. So happy to simplify it as much as possible, but please feel free to put up a question if you think that I'm getting a little, difficult to understand, or you need some further clarification on a particular subject or a topic or a subtopic. Yes. So, is the audio okay? Right. So, how does a bank work? Now, from a definition standpoint, and I'm going to break it very, very into smaller pieces so we understand each aspect of it. But a bank is nothing but an intermediary, somebody who brings two sets of people together. Let me talk about these two sets of people in much, much detail, but to start off with, we are going to segregate these two sets of people into one who has the money and the other one who needs money. Yeah. So in our day-to-day lives, and we as individuals, we sometimes save money, we invest money, sometimes we take money as loan. So at different point in time, we are people who have the money and feel the need to probably save it or park it to be able to generate some return out of it. Money kept in a bank will earn some interest because you've given your money to somebody who's using your money. And which is why you see a bank is a financial intermediary that accepts deposits and at the same time is giving that money to somebody else who needs it. Now, ordinarily, if we were to talk about these set of people, how will a person who needs money identify somebody who has the money? Clearly, there has to be some central point where these two parties can meet, not literally, but these two parties can go to and do what they want to in terms of one who wants to invest and the other one who wants to take money. And which is why the word financial intermediary, somebody who brings these two people, these two sets of people together. And as the line below also talks about, it's a connection between customers who have capital deficits or capital surpluses. Don't go by those jargons if they sound a little difficult to understand. But what we are saying is that somebody who probably wants to start a business, let's say, needs money, goes to a bank asking for a loan. But where will the bank get the money from? It means that somebody on the other side who has surplus money is parking that fund, that money with the bank, obviously for a return. So this activity of intermediation is nothing but a bank's business. Now let's try and understand, and I'm going to spend a lot of time on this particular slide to understand the entire financial system. And before I talk about what's there on the slide, let's just take simple examples for us to kind of relate to. Some of us, let's say, would be working. So you have a salary coming in, and that is deposited into the bank. Now, you spend some money out of it for your expenses and so on, and the rest of money stays in the bank. And for the moment, I'm just taking as an example that it stays and you don't do anything with that money. It's lying in your savings bank account, and I'm sure a lot of you would be able to relate to this particular term, savings bank account. That's the bank account that you normally operate. And look at the word, saving bank account. Yeah? So it's nothing but your normal, simple savings that is parked with the bank. Now what does that bank do with the money that you have? By the way, and maybe most of you know about this, is that you do earn some interest on this particular money that is parked with the bank. So the bank on the other side is using this money and giving it to somebody else who probably needs a loan. And some of us, again, will be able to relate. We would have approached the bank probably to get a personal loan, let's say. So at some point in time, because we park our funds with the bank, we are lenders to the bank or savers. And on the other hand, because we need money, we go to the bank and take a loan. That makes us the borrowers. And it's not just about the savings bank or the money that's there in the account. But a lot of us, let's say, invest in various different, investment opportunities or avenues, like let's say mutual funds or insurance and so on. Please remember that all of these funds that we as individuals invest in these financial investment avenues is also rerouted and given to somebody else. Could be government, could be corporates, could be institutions. Let's say taking an FD with a bank, a fixed deposit. So you have ₹1 lakh of rupees, let's say, for example, and you take a 1-year fixed deposit with a particular bank. The bank, given today's interest rate, will give you roughly about 6.8 or 7%. Now what happens to this 1 lakh? Now the bank's committed to you that it's going to return your money after a year and obviously give you a 6.8 or a 7% on 1 lakh. The same money, let's say, on the other side, is given as a personal loan to somebody. Now the interest charged on the other side to the borrower is around 9.5, 10%. Can vary slightly from bank to bank, but this is going to be largely the rate. Now look at the difference between the two. 3%, the difference, is it bank's profit? The answer is no, because banks have costs, the cost of capital, the cost of the infrastructure, the various other costs, the overheads. So 2.5% approximately is owing to these costs. And what a bank makes is roughly about 1%. Now this is just a very simple example to make you understand the banking business as such. And of course, the interest rates will vary. Simple example again, if somebody whom you are lending money has a great track record of repayment. So if I give, say, 10,000 rupees to a friend who always returns money on time, good credibility, there will be an X percentage. But somebody, if I'm not very sure, is going to return money or may make delayed payments, I obviously want to get compensated for it. So the interest rate for that particular borrower is higher. So if I were to charge, let's say, 9% for X, but 9.5% to Y, this 0.5 is nothing but the additional risk premium. The additional bit is for the extra risk that I am taking, which is why you see the interest rates for various institutions or individuals or different, the credit score is different for others. So the interest rate varies. Now the entire financial system, getting back to this particular slide again, the entire financial system is a set of people on both sides. It could be households, business, governments. They are lenders. Just as we have, let's say, additional funds which are our savings and we would want to invest, so would be the case with corporates. They make profits. They have some surplus money coming in which they do not intend to use it in the short term, in the next 1 or 2 or 3 months or 6 months. They would want to park that money. Money has value. So if there is a surplus money in your account, the prudent way of looking at it is to say that let's invest it. Money has value, money can generate money for you. So you have a set of people, could be individuals, could be businesses, could be corporates, governments, anybody for that matter, whoever has surplus money should and does lend money. Now who's the borrower on the other side? Again, the same set of people. The question may come in, an individual, can he be a lender and a borrower at the same time? Yes, of course. Because I may have some funds which I want to park for a shorter duration, let's say. I want to take out an FD so that I can get some liquidity or some money after 1 year. At the same time, given my long-term requirement, I may also go in for a home loan. So I am an investor, I am a lender on one side, at the same time, I am a borrower as well. It's quite possible. Here the thing that needs to be noted is the element of time. Short-term, medium-term, long-term, and so on. So if I could be a short-term lender, but I could be a long-term borrower, quite possible, or even vice versa. So this entire set of people, be it borrowers or lenders, cannot really deal with each other directly unless we are talking about financial markets. But then that again, the financial market is nothing but intermediation, because there you are getting the buyer to meet the seller. So the element of intermediation will always remain in a financial system. The other way of looking at it is the indirect way, where you give your funds to the bank and the bank on the other side uses that up, lends it to somebody else. So this is nothing but the financial system. I do have some questions here which for the moment do not really pertain to the domain, but those are queries related to careers in investment bank with a background in engineering and so on. So I will definitely spend some time on that, and we can talk about that. Some of the people also are talking about some of the courses which we will definitely address. Moving on, let's get more view in terms of how does a bank function really? So as I had said, bank on one side is accepting deposits from people and using the same money to lend it to people on the other side who need loans. The question comes, and if that's the profit for the bank, then if a bank is getting, let's say, 100 rupees as deposits, ideally, and it would like to lend the entire 100 rupees. Is that the best way to do it? Well, from a profit standpoint, yes, ideally they should be doing it, but let's also understand that what if the people who have deposited this money need the money? Let's say you want to break your FD, or let's say you want to not continue the relationship for the period that you have already specified, and so on and so on. So the bank needs to provide for this. At the same time, the central bank, now when I say central bank, I'm talking about the apex institution from a banking standpoint in a particular country. Central bank in India, should I put that as a question to all of you? Central bank in India is the Reserve Bank of India. So the Reserve Bank of India regulates the banks in India and makes some guidelines in terms of how should they be doing the business. And one of the key things that they specify or tell the banks in terms of running their banking business is the reserves. So the banks, the money that they get as deposits cannot be completely used up to lend it to the borrowers. They have to retain some part of it as a reserve. Now, I'm not going to get into details of this because that's going to take away the scope, and we want to stick to what the banking business is for the moment. But just to give you an overview, the reserves can be in the form, and if you're reading some of the financial newspapers, the SLR and the CRR, statutory liquidity ratio. So, and the word itself somewhere explains statutory, meaning what the compliance rules say. Liquidity is at any point in time, the Reserve Bank wants the bank to have some amounts ready so that it can utilize it if required. Now, having said that, if you're going to keep some money as it is and not lend it, the bank is actually losing interest. Liquidity. I have a question here which says that what is liquidity? Very simply, guys, liquidity is how soon you can or how easily you can turn an investment, suppose into cash, or how ready cash you have, how easily you can convert something. Example, let's say you have a gold coin and you need cash. Can you go and sell it to the jeweler or anybody else? Maybe within 24 hours you're going to get cash. Possible? Yes. Let's say if you have land, yes, of course you can sell land, but is it going to be that easy converting it into cash? Maybe not. It's going to take more time. So we generally say land is more an illiquid investment than what gold is. So cash is the most liquid because it's ready to use. So that's liquidity. Yeah. SLR and CRR. So again, I have a question here in terms of what is the percentage. So the RBI from time to time will set these percentages. The SLR today is I think about 24%. CRR is in the range of about 5 to 6%. These keep changing, And this is changing because the Reserve Bank wants to monitor, regulate the supply of money in the system. Let me explain that. If there is more money in the system, which means money is easily available, anything that is easily available will have a less value, which means if you were to take a loan, the interest rates will be less because there's a lot of money involved. So people will take more loans. It's good because then people will buy more properties, more vehicles, car loans, home loans. People will buy that. But in that process, what will happen is that people will be ready to give more money for the same property or commodity or vehicle, which means the prices will go up. So if today a particular property, let's say, costs a crore, somebody will be ready to give, say, 1.05 or 1.1 crore for the same property, which means you have to give more money to be able to buy that same property. So money has lost its value, its purchasing power. RBI has to look at that as well. On the flip side of it, if there's less money in the system, people are not going to be able to take money because the interest rates is going to be high, which means there won't be a lot of houses sold, a lot of vehicles sold, which means the growth in the economy is not going to be as much. So it's a situation where you try to have growth in the system, yet control the prices, call it inflation. So the central bank, from time to time, and one of the ways to control the money supply in the system is the reserves. So the SLR and the CRR are the popular ones. I think one other thing that I want to make a comment here, and I would like to urge people who joined in today, is try and read newspapers, try and see some of the finance channels, even if it may sound a little difficult to understand, but when you keep reading it, it will only add to your knowledge, it will help you. Yeah. So getting back to the topic, so that's how the banking system as such works. And the banking balance sheet. Now, what is now, and for people who are not from the finance background, let me talk about a little bit about assets and liabilities. Now, assets are nothing but the things that we own, something that have a marketable value, something that we can sell, something that we can call as our own. Liabilities on the other side is nothing but something that we need to pay to people. So if I owe you $100, then in my books I'm going to call it as a liability because that's a loan from me, I need to pay you. If I own a property, then that's an asset for me. I have a question here. Does all assets have monetary value? Well, technically yes, unless and until you are able to define it into monetary terms. How does that? It's an asset, right? If it does not have a monetary value, it's an emotional value, then that doesn't really count. In financial terms, an asset. Having asked this question, let me also say that, let's say you own a painting, yeah, and or for that matter any other asset, but you're not able to sell it. Yeah, does it have a monetary value? Yes, of course it has a monetary value, but nobody's buying it. So what is the value of it? So unless and until you are able to ascertain the value of it. And value, again, if you try to explain this, is the price that somebody is ready to pay for it, right? So anything that has a monetary value from a financial perspective is an asset. Yeah, we tend to use this word in some other context as well, but from a financial standpoint, yes, there has to be a monetary value. Getting back to the banking balance sheet, look at their business. The deposits that they get cannot be called as their assets because they got to pay back. But the money that they've lent is something that they're going to expect back, and that is the asset for them. So slightly the reverse way in terms of a banking business. So the banking system, if you kind of look at the business and the functions as such, is a safe place where you can put your excess cash. Please note that just keeping the money in your savings bank account, yes, that does earn interest for you, but that's not really an investment that you have voluntarily done. You can take out an FD, that's your investment. But a bank is a safe place where you can keep your excess cash. There are economies in this world where, so the normal way is when you keep money with your bank, the bank pays you interest, isn't it? But not necessarily always. There are banks or there are banking systems in the world, because the interest rate is so low, they actually charge the depositors a fee for keeping their money. Slightly exceptional, but that's also a fact. I do have a question, let me take that. Credit in savings bank accounts earns interest too. Yes, of course it does. Yes. So if your money is lying in a savings bank account, the bank gives you roughly around 3.5 or 3%. Some of the banks these days also offer 6% as well. But yes, to your point, that does earn interest. And there's a way to calculate that as well. They take your deposit from the 1st of the month to the 10th of the month, take it on average, and so on and so on. So there is a mechanism to actually calculate the interest as well. Yeah. So there is a question, and I'm going to go back to the question here, which says that, can you explain how government debt is an asset to the bank? Please note that what we're talking about here is that the bank has invested in the government securities. So the bank, let's say, has bought government security, which is nothing but, let's say, an infrastructure bond or a debt. Government also needs money. If you go back to the slides that we were talking about the financial system, government was also a borrower. Yeah. So in this case, when government is coming up with wants loans, reaches out to any investor and says, I need to build bridges, I need to create infrastructure, I need to do expressway, for which I'm going to need maybe money for 10 years, 20 years, 25 years. So when they come out with these securities, this loan, and the bank subscribes to those, so bank has given money which it is supposed to take back, so it's an asset for them. Is that clear? Getting back to the next slide. So we talked about the safe place where depositors can put in their excess cash. Now, when you have an intermediary which is accepting deposits on one side, loaning the money on the other side, what you're essentially doing is creating liquidity in the system. You are letting the money flow. You're letting the money change hands, which is good because people who have the money, if they're going to keep that money as it is and not do anything about it, they are losing interest on it on one side. On the other side, if somebody who needs money and gets money as a loan is able to start a business, do something more productive with that money, which means there is growth in the system. So the businesses will grow, expansions will happen, people who have one particular unit or a factory would look to, expand, have more production houses or something like that. So they will need money here. So the bank, in effect, is actually helping the liquidity in the system, helping businesses grow in the system. And the third point, of course, is that the consumer, and today I think one word that most of us are extremely familiar with is an EMI, discounts. So you would have a discount or you would have an EMI facility on when you buy a computer or a phone or a house and so on. So practically all of these white goods or vehicles or homes have this facility where you can procure it, you can buy it, but you don't have to pay upfront for it. And that's obviously thanks to the banking system, because it allows you to pay over an extended period of time. Could be 6 months, could be even 20 years, 30 years, home loans are also available. So here, the ultimate consumer of a particular white goods or car or vehicle is able to buy that because he has the facility of paying for it over a period of many years, which otherwise he would not be able to, because then he has to obviously save that entire sum and buy upfront. So that's from a system of trading winning. Any questions so far? All right, not for the moment. Let's talk about the different types of banks or the banking business as such. Now, the first and foremost, which we as individuals experience it on a day-to-day basis, is the retail banking. And the word retail in finance term will always, most of the times, refer to the business done with individuals. So the retail bank is where we have the savings bank account, the current accounts, the FDs, the banking transactions that you do, be it the RTGS or NEFT, or you write a check and pay your electricity bills or your mobile bills, and that gets credited to the mobile company, gets debited from your account. All of this is nothing but your retail banking. You go to a bank, you write in a slip, a withdrawal slip, and you withdraw some cash. All of that, nothing but your retail banking operations. Corporate banking, and as the word also suggests, that the banking business for corporates, corporations, large businesses, and it could not just be about the loans that the businesses may want to take or invest or take out FDs, but also some of the other financing that the banks do. Let me spend a minute on this bit. Financing always refers that to giving away a loan or taking a loan. So let me give you a simple example. Let's say there could be a let's say a jeweler or a factory owner and wants to expand, so wants a loan, needs to go to a bank and get a loan. Let's say an exporter and has got a mandate to export some commodities to a country in Europe, let's say. So you have a situation where the bank can actually help him by giving funds for him to, let's say, procure raw materials. So a bank not just gives you a loan for various purposes that we spoke about, but also finances some of the businesses, some of the trades, some short-term or some long-term requirements, and so on and so on. Essentially, at the end of it, it's financing. It's nothing but giving away a loan. Yeah. Wholesale banking. Now we go a notch higher to the term wholesale banking is to do with larger institutions. Essentially, corporations, institutions, even governments in some cases. But here the ticket size is big. When I say ticket size, I'm talking about the amount in question. Let's go back. I mean, if you're talking about retail banking, you and I dealing with the banks, we deal in some lakhs, take out some FDs, take away some loans, and so on and so on. Corporate banking's one notch higher. The amount goes into crores, 10 crores, 20 crores, and so on. Wholesale banking, even higher, talking about 100 crores, even thousands of crores. So the segmentation is largely due to the amount in question here. And basis this, of course, the terms of the contract or the product or the way the bank is dealing with them, that can change. So you have a retail product for us, but that may not be the same product that is applicable to a large corporation. So the bank obviously needs to make a new product which is more suited to them. Any questions so far? I think probably time to do a poll at this point. So we'll have a poll question coming up for you guys. And once you've done that, maybe we can resume the conversation. All right, let's resume the conversation. And I have a question, which is, what is the difference between merchant banks and IB or investment banks? So merchant banks have a narrower meaning to it. They're the ones who actually help organization raise capital. They can raise money for you by way of IPOs. Also underwrite the issues and so on. Investment banks, on the other side, have a more broader meaning. They not just help organizations raise capital, but they also trade in secondary market for these corporations, institutions, and so on. So capital raising is one part of their core business, but they do much more than that. They also trade, so they are into secondary market as well. So merchant banking is primarily primary. IB is primary plus secondary, if I can put it in a more simple way. I do have another question, which is to talk about investment banking. Well, investment banking, and I'm going to cover that a bit. So when you have an investment bank, the primary function is to help organizations raise capital, be it debt, be it equity, and also what proportion, what is the best way at what price. All of this is an investment bank's job to manage the entire capital raising end-to-end for its clients. I have another question, which is difference between CRR and SLR. Well, the SLR is the statutory liquidity ratio and the CRR is your cash reserve ratio. Now, these words do explain certain bit, but let me break that down and explain. So, cash reserve ratio is the amount of cash that a bank needs to retain with the RBI to meet its cash requirements or obligations. On the other side, the SLR is again a reserve, but it's in the form of investments. It's in the form of government securities and any other permitted securities by the RBI and so on. So I go back to my earlier point about the banking business. If I have 100 rupees coming in and I'm supposed to keep 30 rupees, let's say, as reserve in both SLR and CRR, and I'm lending only 70, in effect, I'm losing interest on this 30, which is not the best thing to do. So the government says, no problem. On the SLR, out of the 30, you can keep 24 in the form of securities, which means you're investing in these government securities, you're earning some interest on it. So it's not really that you've lost interest on this 24. So that's basically your difference between your SLR and the CRR. Yeah, I hope I've been clear on this point. Moving on. Now talk about again the banking business, but here now I'm going to talk about the entire money flow in terms of what happens to your cash, what happens to a bank. So let's say you're writing a check or you're making some payments or you have received some money by way of a check. Let's take a very simple example. Yeah. Let's say you are paying your electricity bill or your mobile bill. So you got a check, you write a check. And here, I know there are various other ways of net banking and so on, but effectively they are all the same. It's just that technology has facilitated this and made it very, very easy and faster. So let's say you write a check and you give it to, or you put it in the Dropbox. The mobile phone company deposits it in its account. I'm going to put that as a pictorial representation here to show that when the banks that receive the check present it, and as they present it, it's nothing but depositing in their own banks. So this check that is being presented goes to a central clearinghouse. Let's understand that at the end of it, there are so many banks, and all of them are not just presenting checks, but also some of the checks have been presented towards them. So there's a liability as well as there's some money coming in as well. So there will be, let's take an example. Let's say there are two banks, yeah? And Mr. X has got a check. He has an account in HDFC Bank, and he's paid the money to, let's say, Vodafone, and Vodafone has an account with, let's say, ICICI. These are fictitious examples here. So ICICI is supposed to be from HDFC. On the other side, Mr. Y is paying, let's say, an electricity bill. ICICI writes to the electricity company who has an account with HDFC. The amount is, let's say, so see where HDFC is supposed to transfer 3,000 rupees to ICICI. On the other side, ICICI is supposed to transfer 2,000 rupees to HDFC. This being one transaction, very easy to kind of contemplate that yes, okay, money will go from here and there. And ideally, it should not be two transactions, isn't it? 3,000 should not go from here to there and 2,000 from the other side. Ideally, only 1,000 rupees. The net balance or the net obligation should be transferred from one bank to the other. This is a simple example. Let's make it more complex. Think about thousands of transactions every day. And not just two banks, but many banks, several banks, and millions of account holders. Suddenly, the process, though not difficult, but has got a little complex. Here's where the clearinghouse comes in. So the clearinghouse is a central system which at the end of the day will calculate the net obligation. Sorry if I'm using some jargons here, but the net obligation is what is the net amount that a bank is either supposed to receive or supposed to pay when it has netted off all the transactions, all the checks issued versus the checks received, to put it very simply. And at the end of the day, if done mathematically correct, the net obligation of the banks, if a bank is supposed to receive 1 lakh, there will be another bank who's supposed to pay 1 lakh. Or there will be two banks who are supposed to pay 50,000. Whatever it is, at the end of it, the net result will be 0, which means the total receivable has to be equal to the total payment. Yeah. Examples of clearinghouse? Well, of course, yes. There's so many of them. And any financial intermediary or financial system will have an element of a clearinghouse concept. Banks have a clearinghouse, the RBI has a clearinghouse, every central bank in the world has a clearinghouse. Even the security transactions, and I'm slightly going away from the banking system, but you trade on a stock exchange, you buy a security and you pay for it. There has to be an element of clearing that needs to be done. So the exchanges have a clearinghouse. The banking instruments have a clearinghouse. Of course, the monetary part of the clearing when it comes to the stock exchanges is handled by the banking system. But at the end of the day, you have a clearinghouse concept. And this is what is pictorially represented here in terms of how the clearing system in a bank or a clearing house in a banking system works. As you can see, some of the banks which is paid money, presented money, and so on and so on. So that's how the banking system works. What is banking reconciliation? That's another question that I just have. Got it. So, okay. Give you a simple example here. And for people who've been a commerce student, this is a 11th standard concept of bank reconciliation. So let's say I have issued a check in favor of, let's say, Vodafone paying my mobile bill. Now I have a book at my house which says my bank balance is, let's say, 1 lakh rupees, and I cut a check. So my balance, according to me, after having cut a check of 3,000 rupees, the balance as per my record is 97,000. But the bank has no idea about this check because the check has not been presented yet. So the bank still maintains that the bank balance is actually 1 lakh. Now clearly, there needs to be a reconciliation here. So the bank essentially reconciles between the bank statement, or we can reconcile, or any of the parties who have bank account should and do reconciliation from time to time. What they're essentially reconciling between are the two books. One is a bank statement and one is their own, call it the ledger or call it the books of account that they maintain. That's nothing but your banking reconciliation. So what you're trying to do is to ascertain the right balances, which at any point in time may not be the case. Ideally they should be, but that's not the case. So if there is a difference between two balances, between the two statements, clearly there are some open items, and reconciling those open items and ascertaining the right balance, that's what banking reconciliation is all about. Yes, so from my session perspective, this is what I intended to cover. So I'm done with my presentation as such, and as promised, I'm going to keep some time for your questions. But before we do that, I think it's time for yet another poll. So I'm going to hand it over to my team for a sec, and then I'm going to come back for your questions. All right, let's just go back to the questions. All right, I have a question which is, what are swaptions? Well, clearly out of the purview of this particular session, but just to answer you in very brief manner, as the word suggests, you have swaps, which if you look at the dictionary meaning is nothing but exchanging, cash flows. So swap is nothing but exchange of cash flows. Simple example again, fixed interest rate versus floating rate interest rate. So if you have two parties who want to swap the cash flows, somebody who has fixed wants floating, somebody who has floating wants fixed, can get into a swap contract and do the swap. That's a plain simple swap. If I were to create an option on a swap, that's typically called as a swaption. I know maybe this is not the best of the explanation, but given the time and given the scope of it, let's just park it to this much. I have more questions coming in. Well, so here I do have a fresh engineer who wants to get into investment banks, wants to get enrolled into some of the courses. Well, may I just suggest that you can leave in your email address, phone number here, and I'll have somebody from my team reach out to you to give you more details on that. And it would be best if this is handled on a one-on-one basis with you. So leave in your contact details and somebody will get in touch with you ASAP. All right. Does the bank put any limit on individuals while offering loans? If yes, then what are the conditions? Yes, of course. I mean, think about it. If somebody were to come to you and ask for a loan of ₹1 million, would you straight away be okay to lend that kind of money? Would you not want to check whether the borrower is or will be in a position to be able to repay you that amount? How would you be sure that your money comes back? So if you are going to lend ₹1 million, then you will ask for some security, some asset that you can keep it as a security so that your money is safe. Same logic, the bank can loan any amount provided the bank is sure that the money is coming back. And to make that more easy, they will have rules or conditions in terms of how much can they loan and against what security. So yes, there are conditions, and even your credit score, or as individuals you have something called as the CIBIL score, which basically talks about your credit worthiness in terms of what is the financial soundness, or what is your credit worthiness. How sure can a lender be before lending money to you? Yeah, right. All right, I again have some questions around the courses and in terms of hirings or the placements related to courses. Well, of course, I would still suggest that these are questions that can be best taken up by the team here. They can give you all the details. So please drop in your contact details and somebody will get in touch with you as soon as possible. Yep. Right. Concept of outstanding shares and issued shares. Well, this conversation is going beyond the banking system. It's now moving on to financial markets. So be it. Since there is a question, let me take that up. So when companies issue shares, there are shares that are issued. So they have a fixed number which they have pre-decided, taken an approval, and they issue these shares to the public. Not just public, there are institutional buyers as well, and so on and so on. Now, out of that, there are some which are tradable in the market, some for which the amount may not be entirely paid for. So all of these categories are ascertained and is a public information in terms of how many shares are issued to the public, how many are outstanding, how many are traded as a free float, how many are partly paid or fully paid, and so on and so on. So that's my short answer. There is I can go on and on, but I think the time does not permit us for that. I have one more question, which is to do with HDFC trading course. Again, a question on the courses that Imarticus runs. May I please request you to write into the team or drop in your contact details. My team will certainly get in touch with you ASAP. I have a question. Does the bank put a time limit on loans in India? For example, in US for housing loans, borrowers are supposed to pay interest for 30 years. Well, the short answer and the right answer is yes. There obviously have to be a time limit on the loans. Think about it. What if I were to borrow money from you and do not give you a time limit to pay you back? Would that be okay with you? Definitely not. So any lender would want to know and would put that as a condition in terms of when the borrower is supposed to repay. So all loans in India or elsewhere will obviously have a time limit. Any other questions? All right, so, okay, I do have one more question. Why bank will not retain only in CRR policy rather than in SLR? Well, these are not the bank's discretionary reserves. These are something that the RBI mandates, and if you look at why not one of the two, well, obviously, you know, each has its pros and cons. You have an SLR which earns interest for you, but obviously when you're invested that security, it's not ready cash, so liquidity is an issue. So the RBI is trying to say that the bank should earn interest, as well as there should be certain amount which would be very liquid cash, and hence the combination of both these reserves that is there. Why is there so much of a difference in ratio? Well, you have 24%. You can't have 24% cash because that's not going to give you any interest. Remember that. So the larger part or the bigger reserve has to be, very rightfully so, should be earning interest. So the SLR, which is 24%, earns you interest. 6% does not earn you interest. So it has to be less. But that's also important because then you need to maintain a liquid cash as soon as possible. Alright, so that was the last question. Thank you very much for your time. Thank you very much for joining in. Bye-bye.